This is part 2 of session 1 lecture. Let me continue with slide number 14, where we have the foreign exchange market. International financial transactions normally require the exchange of currencies, and the foreign exchange market facilitates this exchange. So money, just a dollar into euro, euro into dollar type of exchanges. And many commercial banks and other financial institutions serve as intermediaries in the foreign exchange market by matching up participants who want to exchange one currency for another. And some of these financial institutions also serve as dealers by taking positions in currencies to accommodate foreign exchange requests. So they have their own inventories of foreign currencies. So investors can buy from these dealers foreign currencies, or they can sell this foreign currency to these dealers. Okay? Exchange rate, which is the price of foreign currency, is determined in the market by the demand for the currency and supply of the currency. Okay, let's move on to the next slide, where we discuss the role of financial institutions. Remember, the role of financial market was the efficient transfer of funds from those who are saving money to those who are in need of capital. Okay, but the market is never perfect, so financial institutions are needed to resolve the limitations caused by the market imperfections, such as limited information regarding the creditworthiness of borrowers. Suppose you have $10,000 you'd like to lend, and you have several candidates you can lend money to, but you do not know the creditworthiness of these borrowers to whom you could lend this money. So here comes the financial institutions. They can resolve the limitations caused by the market imperfections. Okay, usually there are two types of financial institutions: depository institutions and non-depository institutions. Depository institutions are the ones which receive deposits from the investors, and non-depository institutions do not receive any deposits from investors. So first, depository institutions. Depository institutions accept deposits from surplus units and provide credit to the deficit units through loans and purchase of securities. And they're popular because they offer liquid deposit accounts to surplus units, like checking account, savings account, money market account type of things. And also they provide loans of the size and maturity desired by the deficit units. And they accept the risk on loans provided. So they evaluate the creditworthiness of the borrowers, and then they assume the risk. Have more expertise in evaluating creditworthiness than individuals. And also they can diversify their loans among numerous deficit units. So not only one sector, but different sectors. They can diversify, so they can lower the risk through diversification as well. So these are why the depository institutions are very popular, and some of the characteristics of these depository institutions. And we can think of three types of depository institutions: commercial banks, savings institutions, and credit unions. And by far the most dominant type is the commercial bank. And the commercial bank transfer deposit funds to deficit units through loans and purchase of debt securities. Okay, and savings institutions also, they call the thrift institutions, and they include savings and loans and savings banks. They're similar, slightly different. We'll spend a chapter on this. And they concentrate on residential mortgage loans. Of course, they have other commercial loans, but mostly residential mortgage loans. And credit unions are non-profit organizations, and they restrict business to commercial union members with a common bond. Then we have non-depository institutions, role of non-depository institutions. Non-depository institutions generate funds from sources other than deposits, but also play a major role in financial intermediation. So these are some of the non-depository financial institutions: finance companies, mutual funds, security firms, insurance companies, and pension funds. So we'll spend one chapter for each of these 5 categories later toward the end of the course. And finance companies obtain funds by issuing securities and lend the fund to individuals and small businesses. And also mutual funds sell shares to surplus units and use the funds received to purchase portfolio of securities. Securities firms provide a wide variety of functions in financial markets: brokerage, underwriting, and dealers and advising and things like that. And also insurance companies provide insurance policies that reduce the financial burden associated with death, illness, damage to properties. And they charge premiums and invest the money in the financial markets. And pension funds manage funds until they are withdrawn for retirement. Okay, so you can see different types of institutions, depository and non-depository institutions, and how they function. So here are some of the surplus units. Deposit money in the depository institutions, banks, and credit unions, and purchase securities from the finance companies, provide money to buy bonds of these, and purchase security shares of mutual funds. And insurance policyholders pay premium to the insurance companies, and employers and employees make the contribution to the pension funds. And these financial institutions, okay, collect money from these surplus units and invest in these deficit units. So money flows from those surplus units to deficit unit through these financial institutions in the financial markets. Okay. Now let's briefly talk about the institutional role as a monitor of publicly traded companies. These institutional investors, they provide funds for the corporations, but also they serve as monitors of publicly traded companies. By serving as activist shareholders, they are the shareholders, but they are the major shareholders and activist shareholders. They can help ensure that managers of publicly traded companies are making decisions that are in the best interest of the shareholders. In other words, institutional investors not only provide financial support to companies, but also exercise some degree of corporate control over them. Recently, many institutional investors were asking the companies to pay more dividends. For example, from Apple, they were asking for Carl Icahn was asking for more dividends from Apple, and actually Apple decided to pay more dividends in the form of cash dividends and stock repurchase as requested. Okay, and also Internet has enabled the financial institutions to perform their role more efficiently, and most of the banks use online banking these days, which can lower the cost. It allows for lower costs and fees. And also it makes firms more competitive, forcing other firms to price their services competitively. Yeah, all the banks and financial institutions use this online banking. As a result, costs goes down a lot. Let's briefly talk about relative importance of financial institutions. And according to the textbook, size of the total financial market of the United States was 45 million. It is a little bit old data, but you can understand the size of the U.S. financial markets. And out of all the depository institutions, commercial banks hold the most asset with about 12 trillion, about a quarter of total size of the market. And on the other side, non-depository institutions, mutual funds, holds largest amount of assets with about $11 trillion, about a quarter again in aggregate. And the next chart shows where these financial institutions receive money and where they spend money. Then sources and uses of funds, you can go over this, and also we'll go over these different institutions later toward the end of the semester. If you go back, households with the savings are served by both the depository and non-depository institutions, as you can see in the table. And households with deficit funds are served by depository institutions usually, and some finance companies as well. And large corporations and governments that issue securities obtain financing from all types of financial institutions. And several agencies regulate the various types of financial institutions, and the various regulations may give some financial institutions a comparative advantage over others. So we'll talk about these regulation issues much later. Yeah, this is sources and uses of funds for different types of financial institutions, as we discussed briefly. And let's talk about the consolidation of financial institutions, which is a trend in recent years. And in recent years, the barriers to entry to other financial services have been reduced, allowing firms that have specialized in one service to expand more easily into other financial services. And that was made possible through the Graham-Leach-Bliley Act, which is called the Financial Services Modernization Act of 1999. As a result of this consolidation of financial institutions, these financial institutions could provide more convenient services for both individuals and firms. Individual customers can rely on the financial conglomerate for convenient access to multiple services such as life and health insurance and brokerage service, mutual funds, investment advice, and financial planning, bank deposits, and personal loans. So it's a one-time shopping for all different types of financial services. And also corporate customers can turn to financial conglomerate for property and casualty insurance, health insurance, plans, and business loans, advice on restructuring its businesses, whether we should sell more debts or more stocks and stuff like that, issuing new debt, equity securities, and management of its pension funds. So you can see a typical financial conglomerate these days provide all different types of services. Okay, insurance and brokerage and investment banking and mutual funds and finance operations and thrift operations and also commercial bank operations. Okay. Also, many financial institutions have expanded internationally to capitalize on their expertise. Many U.S. banks have entered into China to provide the same type of services. Let's briefly talk about credit risk for financial institutions. Following the abrupt increase in home prices in the period of 2004-2006 period, many financial institutions increased their holdings of mortgages and mortgage-backed securities. Some financial institutions, especially commercial banks and savings institutions, aggressively attempted to expand their mortgage business. It was very lucrative businesses for these banks. In doing so, they applied very liberal standards when originating new mortgages and often failed to verify the applicant's job status, income level, or credit history, based on the presumption that home prices would continue to rise and provide adequate collateral to back the mortgages if homeowners could not make their mortgage payments. And during 2007-2008 period, mortgage defaults increased and home values declined substantially. By January 2009, at least 10% of all American homeowners were either behind on their mortgage payments or had defaulted on their mortgages. And here comes the idea of systemic risk, and that is the spread of financial problems among financial institutions and across financial markets that could cause a collapse in the financial system. This exists because financial institutions invest their funds in similar types of securities and therefore have similar exposure to large declines in the price of these securities. A lot of banks were investing in mortgage securities when the home price went down, and a lot of homeowners defaulted just they were affected altogether. So mortgage defaults affected financial firms in several ways. Mortgage originators sold mortgages to other financial institutions shortly before the crisis. And many other financial institutions invested in derivatives and were exposed to the crisis. And some financial institutions relied on short-term funding and used mortgage-backed securities as collateral. So they were renewing their commercial paper, for example, short-term borrowing periodically, and they were using mortgage-backed securities as collateral. As the mortgage-backed security collateral value goes down, they did not want to renew this short-term lending. So firms could not renew their loans, and they had to go bankrupt as a result of that. And decline in home building activity caused a decrease in the demand for many related businesses, leading to a weak economy. And as a result of that, government stepped in and they bailed out the economy. And they introduced Emergency Economic Stabilization Act of 2008, where they just injected $700 billion into the financial system, primarily by purchasing the preferred stock of financial institutions. So they injected more cash by buying some securities of the companies, financial institutions. And also, Fed provided emergency loans to many security firms that were not subject to its regulation. The Fed rescued Bear Stearns by financing its acquisition by a commercial bank, which is JP Chase. And also, finally, they introduced Financial Reform Act of 2010. And it is referred to the Wall Street Reform Act or Consumer Protection Act. And according to that, we have other items to be discussed later, but mortgage lenders must verify their income, job status, and credit history or mortgage applicants before approving mortgage application. So that is a brief discussion of financial markets and financial institutions. We're going to talk about these more in detail in the later chapters. In the next 2 slides, we have some summary. I'll let you read this summary. Okay? This is the end of session 1 lecture, part 2.